Hey guys, welcome to the live stream. It's exciting to be with you today. We're going to try something a little bit different. We're going to look at the market today and we're going to talk about diversification. But I decided to, based on some feedback I got, especially from my friends who are overseas, that, having a stream a little bit earlier might be a worthwhile endeavor. So I'm going to try this 3:30 my time in the afternoon. And, I'm not sure what time it is where you are, but it's going to be about 30 minutes after the close of the market. So everything's a little bit fresh. So let's go ahead and take a look at what the market did before we kind of get into the stream and see who all's here. So let me do this. Let me present. Share my screen. I should have done this before I got on, but that's okay. We're all in this together. So there we go. We've got tip ranks pulled up here, and it shows that the market today, the S&P 500 went down by 0.15%. The Dow Jones went down by 0.42%, and NASDAQ was down 0.17%. My portfolio was down 0.37%. So I, did a little better than the Dow, but worse than the S&P 500. Let's take a look at the top gainers and losers for at least from my portfolio. Today, Hershey went up. I can't catch a break on Hershey. I keep wanting it to come back down so I can buy some more, but it is continuing to go up even in the down days. Microsoft is up. Kilroy Realty is up, and Medtronic. I'm also trying to add to Medtronic, and it continues to go up as well. So, and then the losers today, Air Products went down 1.74%. That kind of stinks. And CME Group is stock that I own very little of, but it went down 1.5%. EOG has been on a slide here lately at 1.44%. And Prudential went down 1.19%. So those are the top gainers and losers in my portfolio. So let me know in the comments how your portfolio did today. We'll go ahead and take a look at some of, here, let me get this back here. So welcome to the broadcast, guys. I'm excited about this. I really, at first I was really nervous about live streams, but I really like the, the candor and just the nature of live streams. You get what you get. I mean, we are who we are. All this editing that goes on in these videos kind of, it takes a lot of time, but it's also not real, right? This is more real to me. So let's see who all's here in the live stream. We have Pat. Good afternoon, Pat. And we got Bean Count 811. I'm not sure if I've met you, Bean Count. So welcome to the broadcast. Hey, Gnome, welcome, my friend. I'm glad you could join. And Nathan says it's 9:30 here in the UK. Oh, this is awesome, Nathan. I'm going to actually get to kind of put you to sleep tonight. Hopefully it won't be because of the content, but hey, it is what it is, right? So we got Kevin Rayberg here. He says the market beat me up today. I can certainly understand that. Eli has joined the program. Welcome, Eli. It's good to have you here. MPW. We're going to chat about that just a little bit today. I actually have it as an example in the diversification slides for today. So, it's up 7%, but it was way down last week. So, at least they're kind of moving up a little bit. I'm glad for all my friends who actually own it, but it's been a dumpster fire, I think. So we have John Jay in the house. Dresh is here. That's awesome. I'm not sure. Sudden start. What does that mean? Does that mean I just jumped right in? Should I have been a little more, should I have eased into it a little bit, John? I'm not really sure what that means. All right. Guild is up 2.47 and MPW is up 7.96. Those are really good moves. I don't own either of those. Oh, it's 5:30 in I forget Philippines, I think, Billy. So that's incredible. I'm glad you're up this morning, man. it's good to get up and get that day started. So that is really great. So Gnome says it's 11:30 p.m. there. So that's a little past my bedtime, but I am so stoked that you stayed up just for this broadcast. You probably were up anyway, but hey, that at least I can think that way. Okay, Bill here says he just got 100 shares of XL today. That is really good. That's I think that's going to do well. Yeah, so 9:34 in the UK. Was live planned? Yes, sir. It was. It was planned. I didn't set it up until I got the slides done, though. So it was about 3 hours ago, I think, when I finally set it up. He said he's glad he caught it. I'm glad you caught it too, my friend. So let's look at a few more here. We got Bean Count says his fund portfolio is up 0.47, or I'm sorry, down 0.47%, and his income portfolio is up 8%. So that's not too bad. Kevin Mendoza, welcome, my friend. He says, I'm here. I'm watching while at the gym. Now, that is really cool, man. You are working your physical body and you're working your mental body all at the same time. So that is fantastic. We got Mike Chalednik. Let me know if I got that right. Chalednik, does that sound right? So I appreciate you being here, my friend. And we have Suzuki Man is in the house. And okay, I'm going to go ahead and move into the main event here. And that is on diversification. So, I've heard a lot about diversification. And I wanted to kind of lay out for us serious investors what diversification is, why we would want to do it. We'll talk a little bit maybe about Peter Lynch's comment on the diversification. But anyway, this is really, we're just kind of gathered around. Let's envision ourselves in front of like a fire here. We are all just sitting around talking about how we become better investors. One of the ways that we can do that is to understand diversification. So let's go ahead and I'm going to switch over to stop that. And then I'm going to show this screen here. All right, there we go. So diversification, does it matter? And hopefully at the end, we will determine that it does matter. But if not, let me know at the end. Where can I go? Let me go here. Okay, so in order to understand diversification, there's really 4 terms that we need to understand. One of those is volatility. So we're going to talk about volatility. The second one is about beta. You've heard that stocks have a beta. We'll talk about what that is. The third thing is about risk. And the fourth thing is about diversification. So volatility is first. Volatility is basically the degree in which the price of an investment fluctuates. So if you want to think about it this way, when we look at a chart of a stock and we see it moving up and down, the up and down movements is what's called volatility. And sometimes that's measured in what they call standard deviation. But if it goes really high, really low, really high, really low, the volatility of that stock is higher than a stock that just moves a little bit. So this is a pretty simple thing, but it's really important for us to get this as we move into this discussion. So volatility, a lot of volatility is high movement, and very little volatility means there's little movement. There is a way to measure volatility in the stock market, but it is based off of what the movement of the market is. And that's the term that we call beta. So beta is a calculation of volatility relative to the market. So if I have, let me go ahead and move to the next slide. If I have a stock that has a beta of 1, what that means is that stock moves at the same rate as the market does. So it's going to basically track the market. If I've got a beta of less than 1, that means it is less volatile than the market. That doesn't mean that it's going to make more money or less money than the market. It just means it's going to move less. It's going to have less volatility than the market does, both top and bottom. And then if the beta is greater than 1, it's going to have more volatility on average in general than the market will have. So hopefully that makes sense. Does beta indicate how well an investment will perform? The answer is absolutely not. It does not measure performance. It does not measure how well the companies run. It only measures volatility of the stock price compared to what the market is moving. So that's an important point. So we hit beta. We've hit, what was the first thing? Oh, volatility. And now let's take a look. Oh, here's some examples of beta. I forgot I put this in here. So some examples of beta and why this I mean, it's readily available information, but I want to share with you why we have to be careful how we use it. So here's Parker Hannifin, one of my favorite stocks. It's in my portfolio. It has a beta of 1.21. We found out on the previous slide that a beta of greater than 1 means that it has more volatility than the market. So does that mean it's good or bad? You can't really tell. So let's take a look at the chart for the last 5 years for Parker Hannifin. And I've compared this to VOO, which is the, I guess it's the S&P 500 ETF, which I also have in my portfolio. But you can tell that the blue line here is Parker Hannifin. I'm sorry, the blue line is VOO, and the red line is Parker Hannifin. So Parker Hannifin has a high beta, 1.21, but it also outperformed the market, and that's good. But does that mean that all high beta stocks outperform the market? The answer is no. And so, Pat, we're going to take a look at MPW now. Medical Properties Trust. If you've been hiding under a rock over the last couple of weeks, then maybe you won't understand all the issues that are going on. But hey, Medical Properties Trust has really struggled. Their beta is 1.66. Again, they've got a high beta. And so you would think, hey, Parker Hannifin had a high beta. They outperformed the market. So what does that mean for Medical Properties Trust? What that means is that the blue line again is VOO, it's the market. The red line is Medical Properties Trust. All the beta shows us, and you can see the volatility. Here, let me go back to Parker Hannifin. You can see how big the movements are here compared to the market. And the market has, lower movement. So it's going to be a higher beta. It's going to be higher volatility than the market. Medical Properties Trust also has higher volatility, but it has lost a lot of money compared to the market, which made money. So beta is important to understand, but it's also important to understand that it is not a stock selection criteria, at least from my perspective. Okay, so that's that. Now let's move on into risk. Now, the definition of risk in a very simple term is that it is the possibility that something bad will happen. So the difference between risk and volatility is that risk are the bad things that will happen. Volatility measures the movement overall. Risk are the things that will drive the stock to underperform. So those are really the things that we want to manage. We want the volatility moving up. We want that Parker Hannifin moving up. We don't want that Medical Properties Trust when it goes down like that. So we want to try to manage the risk, which is the downside. We want to capture the up, but we want to manage the bottom, if that makes any sense. There's two types of risk. One is systematic. Those are market risks. So a systematic risk is a risk that can affect an entire, or at least in large part, the economic market. So let's think of it this way. The pandemic, the COVID pandemic, is a systematic risk. It is something that impacted the whole entire market. The law of the wars that are going on in the Middle East and in the Ukraine and all of the geopolitical tension that is in the world today, that also is a systematic risk that has a chilling effect on the market in general. Unsystematic risks are those that are specific to either a company or its particular industry. And so when we think about risks that we can manage, those are the risks that are manageable, while the systematic risks are really difficult unless you pull, all your money out, put it in cash, or have some kind of gold, which I don't suggest, but there's ways to try to get around systematic risks, but it's really difficult. So, but from a stock perspective, it's the unsystematic risks that we're trying to manage. What are some of those? Well, you've got operational risk, and just to define maybe a couple of these, I won't go into depth in all of them, but operational risk is when the company just doesn't perform. They have some goals out there. Maybe they've got plants that get shut down. They're just not productive. There's just there are operational risks out there that they just don't produce as efficiently as they had planned. And so that's operational risk. You got financing risk. Maybe they're not able to get the financing that they need from their banks, and so that could be a risk. They've got default risk if they don't pay their debts. Interest rate risk. So as we know, interest rates have gone up recently. That is a risk. That's a very real risk. And so the question is, how do we deal with that from a risk perspective? So you can see that there are a myriad of these risks. And one of the ways that we can reduce unsystematic risk is through diversification. So diversification, let's define it. I looked online at the dictionary to say, hey, what's the definition? And I found this kind of interesting. The definition of diversification uses the word diversify and diverse actually in its definition. How can we define it maybe without using its own root word as the definition? So I went a little bit deeper. I found this on Investopedia, and it says, and it's pretty good, but we're going to adjust it just a little bit. Diversification is owning a wide variety of investments with different characteristics to reduce volatility. And as we learned a little bit earlier, volatility is not always our enemy. We don't necessarily want to eliminate volatility. We want to reduce not volatility, but risk. Risk is what we're trying to reduce. Now, this is partially right, because we'll talk about that in a little bit. But as you reduce risk on the bottom side, you're also going to reduce volatility on the top side. There's just no way around that. So diversification is a risk management strategy that creates a mix of various investments within a portfolio to limit exposure to any single asset or risk. So it's basically having a basket of stocks that have diversification, or that have exposure to multiple industries, multiple countries. So you're trying to spread the risk around, and so let's look at this. So portfolio diversification is an effective strategy used to manage unsystematic risks, that is, risks that are specific to the companies. Keep in mind, this is important, keep in mind that protecting the portfolio from downside risks also limits portfolio gains. So think of it this way. If you have if you have one stock in your portfolio and that stock goes up 100%, your portfolio just went up 100%. If it goes, maybe I shouldn't use 100%. If it goes up 50%, your portfolio went up 50%. If it goes down 50%, your portfolio went down 50%. Now let's decide, hey, we're not going to have one stock, but we're going to have two stocks equally weighted in the portfolio. One stock is flat. The other stock goes up 50%. Now, instead of your portfolio moving 50%, it's only going to move 25%, because You have two stocks, not just one. You have diversified your holdings. Same works on the bottom side. So some important stuff here. How many stocks are sufficient for diversification? That question comes up a lot. It doesn't necessarily come up with in my group as much, but I see that question a lot. How many stocks should I have in my portfolio? What's a good number of stocks? Why does it, how many stocks should I have, basically? And so the question is, from a diversification perspective, how many stocks are sufficient for diversification? And you're not going to like the answer to this. There's been a study published in the Journal of Risk and Financial Management, and they found that there are simply too many variables to consider. And this is in quotes, an optimal number of stocks that constitute a well-diversified portfolio does not exist. So they're basically saying it's impossible. You can't you can't fully diversify your portfolio. And I would even suggest that you don't really want to. So let's move on then to the takeaways. Takeaways are: diversification serves to reduce your portfolio risk. It limits both the positive and the negative returns, though. So to get some diversification of risk on the bottom side, you're also going to be limiting that top side just by definition. Investing is a risky endeavor. And I put that in here because it's important for us to understand that the reason we're making money in the market is that we are taking on risk. So the idea of diversifying our portfolio is a way to manage that risk and reduce that risk, but recognize that we could be limiting our future returns through our diversification efforts. But they are important, and it's important to have those. Lastly, it's impossible to remove all risk from the portfolio. Think about it like this: if our portfolios, if we wanted to fully de-risk our portfolios, then we would make no money, because we would, maybe we use diversification, we use all these other strategies to diversify our portfolio, and then if we fully wanted to de-risk it, we would then pay someone to ensure us not losing money, and so they would take on that risk. We would end up paying them a premium to do that as insurance, and that premium would likely be more than what we would make in the portfolio. So at the end of the day, we cannot de-risk our portfolios, because risk is what causes us to make money. So we don't want to get rid of risk, but we do want to manage it, and diversification is a good, solid way to do that. So that being said, I'm going to come back into the broadcast here. Oh, and I left Suzuki Man up. So glad you're here, Suzuki Man. All that airtime, my friend. That's good. Let's see. Where am I at here? Okay. So let me know what you think about diversification. Do you think about diversification? Is it something that's important to your portfolio? Does any of this hit home? Is there any one takeaway from this that was meaningful to you? That would be helpful for me moving forward. Let's see. What does this say? John J. So would you say that a 1.5 million is enough to rely reliably on 50K income per year as you have that? I would say absolutely. And it's possibly even more than that. And the reason I say that is because my portfolio is not really designed to maximize income. I've got a small piece of my portfolio that's really focused on income, but the majority of my portfolio is focused on dividend growth. So I've got some, Microsoft is an example that's actually less than 1% yield. So I don't have my portfolio in high yield. So a $1.5 million portfolio, if you had a high yield, let's say you averaged, 4%, let's say 5%, because the math is easier. So 5% would be 75 grand a year. And I think that's very doable. I mean, you mix in some Altria Group, which is almost 10% yield now. with some other stocks, I think you could probably average out a 5% yield. So I would think $1.5 million would get you about 75K if you really focused on income. I don't do that personally. I'm focusing also on growth. So hopefully that's helpful. Kevin says he got the YouTube notification. That's fantastic. Let's see here. Oh, we got Fast Eddie. Welcome, Fast Eddie. Good to have you here, my friend. Okay, Mike says I pronounced his name spot on. He's delivering for UPS at the moment and listening to the stream. Fantastic, Mike. I am excited that you're here, my friend. Bean Count says, here come the slides. Absolutely. Because, you know, what I'm learning is I really enjoy sharing what I've learned. And so slides are a way for me to do that. It kind of keeps me focused. It keeps my thoughts kind of, moving in a direction. And hopefully it keeps you guys engaged as well. I could probably do a better job on them. I mean, they're just basically typed on a slide, but, you know, it is what it is. So Christopher Dukes says he picked up some more Pepsi this morning when it dipped really past 1.6%. That's fantastic, man. Pepsi is definitely going to be around for a long, long time. So you can't go wrong picking up some Pepsi. Suzuki Man says he doesn't always consider beta. That's good. And he says it's always good to have a low beta stock. I think, my friend, if we look at Parker Hannifin, sometimes it's good to have a higher beta stock. So, but lower beta stocks like Lockheed Martin can also be fantastic returners as well. Let's see here. What's got Dresh, what you got going on, buddy? Volatility isn't always a bad thing. I agree 100%, Dresh. Let's see. So Dresh also says MPW is about to go to the moon. You could be right. You could be right, Dresh. The challenge for me is that I even considered whether now was a good time to get into MPW. And the more I looked at what's going on when I think of risk management, we've got a management team that's done some very risky things. And one of the ways I like to manage risk is to have a management team that's going to be managing it for me. So I'm not really trusting that management team at MPW. Is there money to be made there? Probably. But I kind of feel like I'm gambling to get it. And I'm not a gambler. I'm an investor. So I'm going to pass on MPW. I hope it works out well for you, my friend. I hope it works out well for everybody. I hope they turn it around. I hope it goes up 10 times. But I'm just not gonna throw any of my portfolio in there. Hopefully that makes sense. Correlation is also important. Correlation is a correlation between two different things. So a correlation, you can have correlation between a stock and the S&P 500 or correlation between two like kinds of stocks. So it's important, but it's really hard to find any graphs on it. Let's see here. Philip, my friend, is in the house. He says he's at work, so he'll watch tomorrow. He likes it always. It will be a good video. Absolutely, my friend. It is going to be a good video for you. So happy tomorrow to you, Philip. You'll see me tomorrow, my friend. All right. Christopher says he currently holds 15 individual stocks and 2 ETFs. May add 1 or 2 more stocks at max. So that's a great point to bring out, and that ETFs are, by definition, they are exchange traded funds, and by definition they hold a basket of stocks. So even if you held one ETF, let's say you held VU, which is the S&P 500, you would, by definition, with that one holding, be diversified, because you're holding 504 stocks or whatever it is in that portfolio. If you are, in something like SOXX or SOXQ, which is a semiconductor um, ETF, then you would be diversified within the semiconductor industry, but you would still be exposed to, you would not be diversified outside of that industry. So I think it's good to have some diversification among your ETFs if you are focused on individual industries in your ETFs. But if you are, S&P 500 or VTI, which is the total market, I think you don't need a bunch of different ETFs because one S&P 500 VTF or a VTF ETF is diversified. So if you've got Christopher a couple of ETFs along with your individual holdings, I think that's perfect. I don't think that you need to do anything else in terms of diversification. I mean, it depends on the weightings, right? But I mean, if you've got a decent amount in your two ETFs and you've got some stocks out here on the side, I don't think you're as concerned about the diversification because you are, by definition, diversified in your ETFs. So it's a long comment, but I like what you've done here. This is the way I would do it if I were starting over again. Let's see here. Bean Count says maximum volatility is damping. Maximum volatility damping will end up with all cash short-term bond portfolio. Yeah, I think I'm following that, and I think you're right. It's may even be worse than that. It might be that you're even below the risk-free rate because you're just trying to get rid of all the risk, and the only way to get rid of it is to get people to take it for you, and the only reason they'll take it is if you're paying them to do it. So it would be better to go into some kind of savings account or something like that if that was our goal. Pat says, what do you think of SPYD? Also, what does representative sampling technique mean? Well, that's taking me back to my my statistics days, and I'm gonna give what I think it is, and maybe we can look at it later and find out that I'm totally wrong. But representative sampling technique means that, first of all, it's a sampling technique. They're not looking at the overall portfolio, and they're picking representative samples for the sampling technique. So it's basically just a sampling type of activity. So SPYD, I'm not sure that I remember what SPYD is. So let's go to, just so that I can get that, it's got to be S&P 500. High dividend ETF. Who runs that? Oh, Spider. So it must be, I don't know who runs this. I guess it's State Street Global. Yeah, so State Street Global. Let me go, let me put this on the screen so that you can join in the fun. I don't want to do this by myself. Okay, here we go. I'll remove Pat. So SPYD is the S&P 500 high dividend ETF. So it sounds like, and see here, it's started by State Street Global Advisors. It's called Spider, but SPDR. It's the S&P 500, and evidently they are picking high dividend stocks out of the S&P 500. There's they've got dividend growth of -8%. The dividend yield is pretty high, 4.63. I would have to look at their individual pieces, but their last 5 years is a pretty slow dividend growth. That kind of makes sense, though, right? If you're going after high yield, you're typically not going to get high dividend growth. So this doesn't surprise me at all. I'm not familiar with SPYD, so I don't know what their fees are. That would be one thing that I would want to look at. But those are my initial thoughts, Pat. SCHD is the one that comes to mind. That's usually I guess that's the sexy term for an ETF that pays a higher dividend. Um, so that would be one to compare it against if you were going to be comparing it to something, I think. Let's see. Bean Count says, I consider diversification in a broader light of asset allocation. Yeah, I think you could do that as well. And of course, my focus here was on stock investing. There's also the thought of even a broader allocation of assets, which I actually do as well. I not only do I have stock market investments, I also have real estate investments, which gives me some diversification outside the stock market. I also have cash, and I've got even some precious metals that are actually physical that are in my safe. And it's not because I think investing in precious metals is a great investment strategy, but I do enjoy looking at these older coins. Maybe someday on a live stream, I'll bring them in and I'll show some of them to you. I really enjoy that. So yeah, I agree with you, Bean. We'll just call you Bean for short. You must be an accountant, because I was an accountant and they always called me a bean counter. So it's helpful, but not generally a fan of neutral portfolios or all weather approaches. Yeah, I'm with you on that as well, because without risk, we don't make any return. So I don't want to be neutral. So we got Slammer 6789. Welcome to the program, my friend. I'm interested in a company, BKE, that is issuing a special dividend. Sorry, I got distracted. Issuing a special dividend. It's rather large, $2.50 a share. What is this? How reliable? Well, I'll tell you what, Slammer, let's take a look, my friend. We'll go to Simply Safe Dividends. It's called Buckle. It is. They have rated it as a borderline safe. It's got a dividend yield of 3.27. Let's go down a little bit, and they should show us the special dividend here. But first of all, let's look at the last 5 years. They've grown on an average of 7%. However, they did in 2021, which was related probably to COVID. I'm not really sure. But they cut their dividend significantly, and then it bounced back. So that shows them with only a growth streak of 2 years. But you can tell that before that, they had quite a long history of not only paying dividends, but growing them, maybe from 2014 to 20. So they had at least a 6-year, but they haven't grown it in 1, 2, 3, 4, 5, 6, 7, 8, 9 quarters. But they did give a dividend of $2.50, a special dividend. So maybe I should describe that. And so what is that, right? So there is a way, and I've got a couple of companies that do this. EOG Resources is one, CME is another. They will pay a standard dividend every quarter. They might grow that dividend every now and then, but that is a dividend that they believe that long term they can support as a company with really no issues. They are giving that money to the shareholder, but they are also looking at the peaks and valleys in their business, and as their business does very well, they will look to reward shareholders when the business does well. I think it's a good strategy, especially if you've got a cyclical business, because if you're cyclical, right, if you do well and then you got a down year or two and then you go, really well, if you got that kind of cyclicalness about your business, you want to set that dividend where that peak, that valley is. And then you want to set special dividends for the peaks, because a special dividend is not a dividend that they are going to look to grow in the future. They are only doing that to share with investors with how well the company has done. So it looks like they've done this for the past couple of years. They did a special dividend of $2.65 back in 23, so about a year ago. This year, they have gone with a $2.50 special dividend. That is going to come into your account just like a normal quarterly dividend, although it is an annual special payout, looks like anyway, from them. I do like that approach, but it's got to fit with what you want from your portfolio. And so its other question was, how reliable. I would say it's not reliable. I would not count on it, but it does look like this is their second year in a row of paying it. So, you know, there is some precedent there. If the business does poorly, maybe it goes down. Maybe they continue to have it, but it's not $2.50 anymore. But that's kind of the way I would look at it. I don't count on the special dividends as coming in until they actually announce that they're coming. So that's the way I look at it. Okay, Kevin says he holds 34 positions, originally wanted 3 positions in each sector, made a couple of less than wise buys, and we have all done that, my friend. But overall, I am up $130 against cost, earning 5.6%. So that I guess that's pretty good, man. $130 against cost, and he's earning a 5.6% yield. I think is what he's saying there. So that's fantastic. Gnome says, I agree overall. However, I'm stuck with stocks, say in the insurance sector, that I have gains on. Consolidate them, meaning selling some and having a tax event. Yeah, that happens. You know, if you've got some stocks where you have made a lot of money on them and you don't really want to pay the tax on it, sometimes you just have to let those stay off to the side and continue building the rest of your portfolio to actually get your portfolio up to a level that even though you got the same investment here in these insurance companies, let the rest of your portfolio grow and surpass that. That's the way I've done it. And, hopefully that makes sense. Let's see here. I got to get caught up with you guys. I'm not really sure how far behind I am. So beyond about 20 stocks, you're at risk of shadow indexing or not following them that closely. Yeah, that is one of the risks. You nailed it. Shadow indexing, I guess, would be where you are building so many stocks that it's almost like you're building the index. And then secondly, and I think the most important piece is that if you got so many stocks, you just can't watch them all. You can't keep track of them all. And that produces risk into your portfolio that wasn't there to begin with. So I think that's a great point, Bean. Dresh says, I own a small position in MPW looking to sell near break even. The bad news is exhausting. Yeah, it just keeps coming, man. I don't know that it can get any, I said this last time, but I was like, there can't be any more. And lo and behold, there's more. So, I'm not really sure. And to be honest with you, I don't study it. I just looked at it the other day. But yeah, it's just something that I'm just not interested in that. I mean, there's a lot of money to be made there if they do well. And so, I certainly don't blame people for buying into MPW. It's just not my gig right now. All right, Kevin, he says, I'm in between sets, but I have 80 stocks. I know that might be too much, but I love collecting stocks. Well, I would say, Kevin, it depends on how much time you want to invest in your portfolio. And, 80 is a lot. It's a lot of stocks. But it's not the most that I've ever heard of. I've heard of people having, in the hundreds. So, for me personally, my goal is to be somewhere between 25 and 30. So that's kind of where I'm at. I'm at 33 at the moment. As a matter of fact, let's go take a look here. You can see I have 33 holdings in the portfolio. There's probably 4 that I could sell today if I thought the market was right for it, but and they're small, they're little, they're small pieces of the portfolio. The challenge that I have is with this channel, I'm going to tell you guys what I sold, and you're going to go, wow, you sold that? What's wrong with that stock? And there's nothing wrong with it. It's just that it's such a small piece of my portfolio, and I can either add to it or sell it. And if I've got too many holdings, I may just want to sell it. Yeah, who knows? So that's kind of where I'm at. But it is fun to collect stocks because I was up in the 40s last year. So I certainly get that, my friend. So favorite sector. Okay, Miguel. Miguel says an opinion on Tootsie Roll Industries. First of all, I really enjoy Tootsie Rolls. I mean, I know it's not real chocolate, but they are so good. Um, let's go take a look at Tootsie Roll. I think is it TR? Oh, nailed it. Tootsie Roll. It's got a dividend safety score of 99, dividend yield of only 1.05. So it is very safe, but also a very low dividend. If my memory's right, they have something weird about. Let me see. They don't have any special dividends, but I want to say that something comes to mind about the way they handle their dividends. It's almost like there's some kind of stock buyback in the middle of all of that. I don't really know. I would have to go back and check it out. But they do grow their dividend. It's pretty slow grower, but it's very safe, and it's a very low yield as well. Let's take a look at. Let's go into. What do we want to go in? Let's go into tip ranks, and go into Tootsie Roll. See what they look like. Let's look at their chart. Let's go back. Let's look at the last year. Wow, they have gone down significantly in the last year. Let's look at the past 6 months. Looks like a mountain with two mountains with a valley. The last 3 months, I'm sure it's going to be way up. So they've recovered, but overall in the last year, they are significantly lower than where they were. So that's I was going to see really quick. Oh, let's look over here. See what the beta is. Beta is 0.42, so it is less volatile than the market, and so it's actually lost money compared to the market. Yeah, I don't know, my friend. That not sure what else to look at there. I mean, I like the safeness of their dividend. I don't like the yield. It's really low. Let's continue maybe to look at some of these financials. The earnings payout ratio is very low, so that looks fine. Earnings per share is going up. Free cash flow looks good. Their shares are coming down. I think that's related to what I was talking about earlier. Their total sales have skyrocketed. There must be some run on Tootsie Rolls in the chocolate world and the candy world. Their return on invested capital is around 13%, which is not too shabby. And they have a net debt of zero, and what that means is they have more cash than they have long-term debt. But what does this mean? 1.08. Oh, so this is where charts can kind of get you into trouble. So the interest coverage ratio, normally we like for that to be 8, and this says it is 1.08. So you would normally go, that's not very good, right? But you have to really pay attention, and this is in thousands. So this is actually 1,080. So they are well covered on their interest coverage ratio. So I think the financials look good. But yeah, let me know, Miguel, if you're going to buy into to Tootsie Roll. That would be kind of fun. Oh yeah, absolutely, my friend. This is fun to me. I really enjoy the collaboration and kind of working together. As a matter of fact, I'll share with you guys a little bit. I'm really putting a lot of thought and a lot of planning and into this whole YouTube space and the what I would bring to this and the channel and all of that. So look forward to something in the next month or two about maybe even rebranding the YouTube channel. But this is the part that I really enjoy about this YouTube channel. It's actually working together and coming up with ideas, researching things together. It's that collaboration that I really enjoy, and I want to do more of that moving forward. So I appreciate you saying that, because that is spot on with where my heart's at. All right, Gnome. I also get special dividend from AFG Insurance every year. Yes, sir. That's another one. Yes, CME. I actually own CME. They pay a special dividend, and it's big. It's like $5 and something per share. I haven't gotten it yet. I think it was the ex-dividend date was January 4th, so it's probably later in the month. But I think I only own 25 shares, so it's not going to be a huge number. Yeah, so Dresh, I think you're right. I think it's this annual stock split thing. There's something funky that goes on with Tootsie Roll and the way they manage their stock. So, and I don't know if it's I've had it related to the way they paid their dividend, and but it may not be that. It's just a funky way that they handle their stock numbers. So I'll have to look that up after the show just to get kind of more into it. Lucas is in the house. Welcome, Lucas. I got your message from earlier, my friend. I appreciate that. That was a great memory. And Lucas was reminding me of when I was on with my buddy Russ from Dapper Dividends, and we were talking about the chickens that we have on our farm. And Russ thought it would be hilarious if we did a something about chicken picking stocks, so but I could never figure out how to get a chicken to objectively pick a stock. I mean, I could put food out on a board, but I would have to pick the stocks that would be on the board. You know what I mean? So I couldn't figure out how to make that work, but it was a fun idea. Um, Lucas, I don't really know. I don't even know what time it is. I'm enjoying being with you guys. So yeah, looks like we got a few minutes left here on the stream. So glad you were able to join, my friend. Okay, Gnome, why do I need to constantly track my companies? If I bought excellent business, why should I look at it more than once a year, a quarter? I have BRK, Costco, Amazon, Google. I do not need to check them daily. No, I agree with that. No, I don't really mean it that way. But when I think of keeping up with a company, I think of it as every quarter I want to know what's inside their earnings, and if there's anything that I need to be aware of, and they will let me know. They're either through their 10Q or 10K, or even on the earnings call, or in some slides that they have. So it's important for me to kind of not only at the beginning when I do the research, but also just on a quarterly basis to make sure that the theme that I have for that company has stayed the same, and that they are making progress on those goals. So I want to see that that's actually happening. So I would say quarterly is fine. But if news comes out, like this news on MPW, so if you're not investing in something that's going to come out with some news like that, maybe it's okay. But there are times when companies, what I call crap the bed, right? So they have some bad news come in, and it's important for us to keep up with that. It's not tracking every day. I would call it tracking every quarter, but it still takes time, and if you've got 80 stocks, that's a lot of, even if you spend 30 minutes each quarter on your stock, you're spending 40 hours a quarter looking at 80 stocks. So that's kind of the way I look at it. I spend a little bit more than that because I do enjoy, I enjoy the process. So, but you don't have to. You don't have to do what I do. Nobody does what I do. So that's okay. All right. We've got Lucas here. He wants to keep an eye on Amazon and Google these days, and then that's not a bad idea. It's good to keep an eye on that. I've heard that both of them have some room to run. I don't own either one of them, other than in VU. I do have exposure to them in my S&P 500, and as you recall, actually, you can see it here. I'll show it to you. I'll sort this in percentage of portfolio. The reason I say I have a VU and I've got exposure is that 30% of my portfolio is in the S&P 500. So I do have exposure to stocks that don't pay dividends that are trapped inside these ETFs or this ETF. So I think that's good to know, and I think it's good to have as well as part of diversification, right? So maybe I should flip this back. There we go. That's better. Okay, where are we at here? Pat. Oh yeah, Pat, this is great advice. I appreciate you reminding me of this. Hit that like button, guys, and what that does is it just lets people know that there's people out there that do like the content. So I appreciate you bringing that up. How do I diversify? Thinking of the next 10 years, or how do you diversify? I think he's meaning me. So I think, so we've got just a couple of minutes left here, but let me show you, I guess, some of the diversification in my portfolio. I'll take this off of there so you can see it better. And so this is one way to look at it. So I have diversification here. You can see by sector, I have no more than, so I guess the way Simply Safe Dividends looks at it is, they recommend you not have a sector that makes up more than 25% of your portfolio. I'm certainly meeting that. I do have a heavy weighting in in information technology. You can see that I have some exposure related to VU, Microsoft, Texas Instruments, IBM. I have a semiconductor ETF as well as some exposure in my dividend growth ETF. There's industrials. I have a pretty heavy alignment in. I've got this stock Stanley Black & Decker that has not done well, but I have Parker Hannifin, Lockheed Martin, again, exposure in VU. I got General Dynamics. I could just look at it on the screen here. RTX, GGG, and then DGRO. So the point is, I look at my sector diversification, and again, I'm not trying to get rid of all the risk, but I'm not looking to have equal weights in all of my sectors either. I'm looking for things that are going to actually make me money in the long term. I've got financials at 13%, healthcare at 10%, consumer discretionary, staples, utilities, energy, materials, real estate, and communication, all very low, single digits in those particular sectors. So that's one way to look at it. Another way is to look at income. Here's a challenge. I think now Simply Safe Dividend says no more than 5% of your income should come from one particular stock. And then you can tell that 15% of mine is coming from VU, which is a collection of stocks. But Altria Group is 10% of my income. It's not 10% of the portfolio, but it is 10% of the income. But I'm not concerned about that. And I've got Whirlpool at 6%, T. Rowe Price at 6%. So this is another way to look at it. So if something went wrong in one of these stocks, that's what my exposure would be from an income perspective. So those are a couple of the ways I look at it. There's also other things that I do. And actually my 5-pillar approach is designed around risk management, because I'm looking at their financial statements. There's a lot of risks in a company's financial statements. So piece number one is I look at their financial statements. I'm trying to reduce my risk by actually picking companies that are solid financially. Second thing is I look at their capital allocation, and I'm trying to make sure that there's risk there as well. And so I want to try to minimize that risk. I don't want to go into these because it'd take forever. The third piece is the valuation. And there is a risk that I could buy a stock and it's already at its peak and it's going to come back down. So there's a risk there. There's a risk in terms of its strategy. So, that's the piece that I look at. And then lastly, there's an execution risk related to management. And so I want to, as somebody mentioned earlier, I want to make sure that my management teams are equipped and capable of carrying out the strategy of the company. So those are ways that I actually minimize risk best I can. And again, nobody can get rid of all of it. So let's see here. Where am I at? Oh, I took it off of the try to get back to where I was. Sorry about that. So Bean's asking, what is my favorite sector? I would say my favorite sector would be information technology. And that is because AI and, that's where a lot of the growth is these days. So I kind of like information technology, but I also love industrials because I get industrials. It's like in my blood. That's that's where my career was. So I really understand those. So those are, I guess, my two favorite. Okay. I think I'm getting back to where we were. Here we go. Slammer, regarding collaboration, one of the other YouTube channels I watch often, The Average Joe, has a separate Discord Patreon. That is a great way to interact with him directly. You might look into that. That is a great idea. I've actually been on a couple, maybe three interviews with Average Joe. I like him as a person. So, and I think that's a great idea, Slammer. As a matter of fact, if I were to show my whiteboard on what I'm laying out here, a Discord is part of that. So I'm glad you mentioned that, and I think that is a good way to go. But I got to work out some details there. But I think it is a great way for this collaboration to happen, and so look forward to that coming soon, my friend. Oh, that's great. You'd certainly sign up. I would certainly welcome you to be in there. So, so Kevin says, I have EMR on my watch list. What do you think? Let's take a look at EMR. Emerson Electric. Actually, I like Emerson Electric. It's a 78. Oh, sorry, I didn't put that on the screen. 78 dividend safety score, 2.2% dividend yield. Let's take a look at its growth. It's been growing pretty slowly, but this is the economy in which to do that. Let's take a look at their payout ratio is fantastic. They had a little struggle with cash flow. I would want to understand what that is. That was in 23, so I'm not really sure if they paid a lot of capital to build a plant or something along those lines. I don't track them. But that's what I would want to know. But it's coming back. See this? It's actually coming back. And sales are looking good. Return on invested capital is pretty normal for a utility. And wow, their net debt to capital looks really good. Interest coverage is 11. Yeah, I think there's a lot to like about Emerson Electric. I would want their yield to be a little higher with such a small dividend growth. But I mean, that's just me personally, but I don't think there's anything wrong with Emerson Electric. They're not really a utility, I guess. They're more electrical components and equipment. So, but I would want either more dividend growth or I would want more dividend yield. So that's just me personally. Sergio, welcome to the program, man. So any thoughts on monthly payers like BST You don't see too many people talking about it. Let me take a look at BST. BlackRock Science and Technology Trust. This is actually a closed-end fund, and that's probably why you don't hear a lot of people talking about it. Look at that yield, 8.82%. So first of all, monthly dividend payers, I don't have any issues with them. I've got one. It's Main Street Capital Corp, and I actually own a little bit of Realty Income as well. So both of those are monthly dividend payers. I don't think there's any real advantage to having a monthly payer, but I don't mind having monthly payers either. So this the one thing I want to look at though with closed-end funds and with something that has a dividend yield this high, they either need to be getting that from their underlying investments, or they're going to be getting it from the here's a way to think about it. They either give it to us from the fat reserves that they have, or they start eating away the muscle. And I don't want them to be eating away muscle, because I want them to be around for a long, long time. So one of the ways I check that is, let's go to Morningstar. This is probably the best place to find it, at least from what I have. So I look for, where is it? Yeah, here it is. So this is the total return. It actually looks pretty good. Here they are, trailing returns. So on a 5-year basis, it's 11.64%. Now this is total return, so it includes not only stock price but also dividend payments. Now three-year time frame is down 6.27%, but the last year is up 26%. So yeah, this it's a closed-end fund, but hey, it could be worthwhile. Looks like it's pretty volatile though. If that works for your portfolio, I think that's fantastic. BRK. Yeah, BRK is Berkshire. I think he was after BST, which is BlackRock Science and Technology. Hey, great, Pat. I'm glad that you would join, and maybe I'll do that sooner rather than later. Who knows? We'll just have to see. So, Kevin, I appreciate it, my friend. We are past time. It is an hour and 7 minutes into the broadcast. But hey, I'm having a lot of fun. And there was something I was going to ask you to do, but I will just wait for the next video to do that. I just don't remember what it was. I'm sure it was really cool. So, but anyway, I hope you guys have a great rest of the week in the market, and I will see you on the next video. Take care, my friends.